Exxon Mobil just reported earnings and the stock is down 2.5%, putting the dividend yield at 4%. Is this a great entry point or is the stock headed for disaster? Welcome back, channel. If you're new here, hit that subscribe button. I'm Ken Kernan, and on today's video, let's get 20 likes, 20 comments. Help me get towards 2,000 subscribers and comment what you thought of today's video and what you want me to talk about in future videos. But let's get on to this massive Excel sheet I've created only about Exxon Mobil Corporation. Stock ticker is XOM. They're priced at $82 right now. They're a huge corporation with a market cap of $340 billion. They have a high PE at 24. They're established after Exxon and Mobil combined and formed one big corporation in 1999, although both companies were around much longer than that before. They have a sweet dividend yield at 4% right now, and they are a dividend aristocrat. This is their logo. This is a subscribe button, so make sure to subscribe if you haven't already. And just as a reminder, this is only educational and entertainment purposes only. This is only this video. If you're seeking actual real investment advice, this is not the place. Make sure to do your own research and determine if this is an investment for you. So let's go over a checklist. They meet all our marks. They have a good starting yield. They have a big market cap suggesting they're well established, nice dividend growth rate, an okay dividend payout ratio. We understand the business and can't really be disrupted by Amazon. Important dates. Basically, they declared their next dividend today. Ex-dividend date is August 10th, and then the actual payment for that dividend is September 10th. So let's get in. This is all data. Let's get in on seeing what's up with this company. So their business model is they spend a lot of money searching for crude oil. They process, they refine it, and then they ultimately turn it into products, either lubricants or petrochemicals. They've done $241 billion in revenue, but on average they've been decreasing at 17 or 16%. So they're really struggling to take advantage of this oil boom. They have huge economies of scale, especially because Exxon and Mobil came together to form this huge company, but it's very cyclical and very dependent on oil prices. This is a cool picture of their business model if you want to pause and check that out. So I don't like their current assets to current liabilities ratio. It is below 1, but their total assets to total liabilities ratio is huge. It's 2.25. I don't like companies with a ton of debt. Interest rates will kill them. And then I like to see good ratio of assets to liabilities, suggesting that the company is ready to acquire or make investments as needed. So looking into their valuation for the past 5 years, they've returned negative 12%, or that's negative 2.5% year over year. Past year return has been 5%. PE ratio is high for the industry. Price to book and price to sale ratio is below the industry average. So that's what they have going for them basically right now. Important trends I see, basically revenues on the decline, net income's on the decline. They're really maintaining steady dividend growth, but that's the cost of having a huge dividend payout ratio. And then it's been slowing a little bit. The 5 to 10 ratio is analyzing the 5-year average dividend growth rate and the 10-year dividend average growth rate of the dividend. Basically, you want the 5-year dividend growth rate to be equal or a little bit higher than this, suggesting that they've been slowing down the dividend growth rate too much, but it is right at 80%, which isn't terrible, but they have a high dividend yield, which I love. And basically, when is net income going to equal the dividends being paid out? Because as soon as the maximum dividends they could ever pay out over the long run is equal to net income, and even that is very unsustainable. So based on 10-year averages, the net income would equal dividends paid in 17 and a half years. But based on the trends in net income and dividends paid based on the past 5-year averages, you'd only get 2.5 years, which is horrible and very concerning. So this is some cool charts I have created. Basically, these lines are what the stock should be trading at based on how it trades at on average with a certain metric. So using the PE ratio, on average, the company trades at a PE of 18.3. Their current PE is a 24. So this is the stock price, just very normal. But this is where the stock price should be at if it trades how it normally traded at a certain PE. So this yellow line suggests that it should be trading right here. The stock price should equal this in order to be fairly valued on average. And the blue line is to be fairly valued on average based on the industry. Basically, all you want to see is the stock price be below these lines. However, it's currently above, suggesting that with regards to the price to earnings ratio, this company is overvalued. Let's look at the price to EBITDA. There isn't really an industry price to EBITDA. I like to look at EBITDA because it's really what are the earnings coming into this company. Basically, all you need to know is that the stock is above what it should be trading at based on its average price to EBITDA ratio. Therefore, it's overvalued in that metric. More price ratios. So we got price to sales ratio. Really, the stock price should be trading much higher based on the industry price to sales ratio. However, based on its previous price to sales ratio, it's a little bit undervalued, but definitely being under the price to sales ratio for the industry is interesting. It suggests maybe something seriously going wrong with this company, or there's some serious concerns. Overall, they have a great price to book ratio, and if based on the price to book ratio, the stock should be trading a little bit higher, but earnings are most important. That's what we decided to focus on. For basically, there's this trends in revenue, net income, and dividends payout. Basically, you see dividends increasing, and then revenue very volatile and decreasing. What about EBITDA? Dividends increasing, that's the red line. EBITDA, ooh, decreasing again. What about net income? Basically, dividends have been increasing and net income has plummeted. Look at this huge difference. That is great. And then these payout ratios suggest that over time the payout ratio has been getting dangerously high. Now let's look at the actual dividend growth rate. So basically, we want to see the stock trade above what its price to dividend yield has been in the past. So on average, the dividend yield has been at 3%. Now it's at 4%. That's why the stock price is here. So traditionally, you'd be getting a good deal for the stock's current yield. So 4% is enticing. But with regards to EPS and DPS, or earnings per share and dividends per share, look, earnings per share has been doing great, and now it's slowly been met by this yellow line, which is dividends per share. And when dividends per share equal earnings per share, that's suggesting the company's paying out a lot of its income towards dividends, so they have much less money to reinvest or simply sustain itself and keep up that high dividend growth rate. So is there hope? Let's look at today's earnings. So basically, the summary of this Money CNN article is that Exxon Mobil has failed to capitalize so far on America's oil boom. So they revealed that today it pumped 7% less oil and gas around the world compared to last quarter. It's a reflection on how Exxon was late to capitalize this shale revolution. In addition, so Exxon Mobil's profits climbed by 18%. That was good, but overall shares at the beginning of the morning dropped 4%. Now it's down about 2.5%. But the key piece of information is that their competitor Chevron has been doing very well. Chevron has, its profits have more than doubled to $3.4 billion thanks to the higher oil prices. Now that's key difference. Competitor has doubled their profits. Exxon Mobil has done barely anything. And that was the main summary of this article. Basically, they're failing to capitalize on the oil boom. So overall, would I buy this company? This is going to be a hard no. Basically, revenue's on the decline, net income's on the decline, their payout ratio is getting very high, and even though they've maintained solid dividend growth, they have a decent balance sheet, I don't see them being able to sustain the business very much or very well in the near future, unless they really slow down the dividend growth rate, which is what you hate to see and you don't want to see as a dividend growth investment. Now, theoretically, if the company was able to sustain itself, I have this cool calculator that determined, okay, well, even though the stock price on average has decreased 2.5% per year, if the company had a starting yield of 4%, which it does now, based on its 5-year averages, it's had a dividend growth rate of 6.2%. So let's say it's able to maintain all of that and maintain those ratios, and we're considering entering a position right now. Well, if we invested $15,000 per year, basically we'd end up with $45,000 in complete passive income after 30 years, and then it would only increase to $133,000 after another 30 years, or quickly gets close to $100,000 in passive income. So the main message I'm trying to give you, if this company could sustain itself, if it could turn around profitability, now would be an incredible time. But due to the trend I see in overall revenue declining, net income declining, and their competitors really making some moves, Chevron really doubling their profits and taking advantage of this oil boom, that is concerning to me. That's why I'm not investing in Exxon Mobil and wouldn't even consider entering a position. Thank you so much for watching the video today. I hope you learned something about Exxon Mobil. I hope you do your own research and decide, is this an investment for you? Make sure to like, comment, subscribe if you haven't already, and I'll see you all in the next video.